What's up? It's episode 56, Payne Points of Wealth, and earnings season is upon us. And for all intents and purposes, it should be a blowout again this quarter. Companies' profits should be through the roof. We have the banks reporting this week so far. JP Morgan's reported. BlackRock blew out the estimates. These are all good omens. But funny enough, investors are extremely bearish right now with plenty of cash on the sidelines, waiting for a correction. We're going to address that today. We're going to tell you what you should be doing with your money, how to play the next move in the market, how to play the rest of the year as inflation continues to kick in. Oil, it's over $80 a barrel at a 7-year high. Folks, inflation is real. It's here. We've been telling you about it. We're going to talk about that. And on the tipping point today, we're going to talk about maybe you've done a great job saving for your financial independence plan, but what are you missing right now that you need to add into your plan to make sure that you're completely financially free? We're going to break it down. Hit the music.
Hey, Ryan, you know what you always say, the market doesn't love you, so don't love it back. And investors don't love it now because ever since the volatility picked up in September, Chris, everybody's worried about slowing growth, bond tapering, rising rates, persistent inflation, the supply chain disruptions, the Delta variant, China, the Fed. Oh, my God, lions and tigers and bears, oh, my. So all of a sudden, you get a little volatility. And what happens to the sentiment readings? What are you seeing there, Chris?
Well, I was talking to one of my clients down in Florida yesterday, and we talked for about an hour about how terrible things are down there. You know, how the virus is infecting everybody, and that the price of gas is $4 a gallon, and that the economy is going to hell in a handbasket, and that, the month of September was a terrible month for a portfolio. I said, you're really looking in the rearview mirror right now. I said, because your portfolio is back up to where it was before September. I said, your portfolio is making a ton of money. The virus is getting better. Things are getting better. I said, you got to look forward. You can't keep looking in the rearview mirror.
Well, Bob once said pessimism is a bad investment strategy. Always better be an optimist. And it is kind of interesting because, as we know, historically, when you get a market top right before it's ready to go down, typically optimism's at the highest. And we've had some volatility, but very little volatility, right? We haven't had any big sell-offs in the market this year. It seems to get going, and then bam, all of a sudden, you get the cavalry coming in and buying up stocks. And that's what makes it even more remarkable. We're going through a period right now where we haven't had that much selling, yet investors are extremely jittery. As we know, markets tend to bottom when optimism's at its lowest. And optimism right now is extremely low, and it's been weeks of that. That bodes well, guys. I want to say it here first, for a huge market melt up into the end of the year, not a market meltdown like a lot of Wall Street strategists been calling for every single week.
So, Ryan, what you're telling me right now, just to be clear, you're saying investors are in the oh no phase, and suddenly they're going to go into the FOMO stage. They're going to be, all right, I better not invest now because markets are volatile. There's uncertainty. Even though all this stuff that we talked about, these uncertainties have been talked about in the headlines for months now. But all of a sudden, the market starts going up. You're going to have the FOMO strategy, right? Fear of missing out. And people will buy higher. Investors will go chase prices as opposed to buying these dips when and if they occur.
Well, to that point, Dad, I was talking to a client of mine last month, and he wanted to sell all of his equities. And he said, I could sell this stuff, but who wants to buy it? I said, well, I do. He said, why would you want to buy it? I said, because the idea is that you buy low and sell high. I said, I'll sell it back to you in a few months when it's gone back up. I said, but at that point, you've already missed the boat.
Well, that's the thing about sentiment that's so interesting, right? Is it can change on a dime. You can go from completely being pessimistic, thinking the world's going to end, and then all of a sudden, like to your point, Bob, everyone gets FOMO because markets are going higher, they're sitting in cash, and that pressure becomes too great, and everybody capitulates at the same time, hence creating a melt up in stock prices.
Well, the market's looking out, anywhere from 3 months to 2 years. Everything that you're seeing in the headlines now is already priced in. For example, the Biden administration came out this morning and said they're going to have the California ports work 24 hours just to try and unload all that backed up supply. And, suddenly it'll resolve itself because, if you look at what's happening with the Delta variant, right, the virus mutated. Well, our economy is mutating, right? We're adapting. and the market's going to see that. So you want to make sure that you understand that any dip is a buying opportunity, not a time to panic.
100%. And, the other interesting topic you're going to hear over and over again during this earnings season is not only how are profits, but how is inflation crimping those profits? That's what investors are going to be razor focused on, because the numbers coming in are pretty astounding at this point, right? You've got oil at a 7-year high, That's incredible. And it only happened within a couple months, right? I mean, we saw oil do nothing for almost a decade. And then all of a sudden, with the flip of a switch, we're now seeing peak oil prices that we haven't seen literally since the mid 2010s. In addition to that, guys, you have world food prices up 30%. That's the highest in 47 years, which also you have to remember, this is a global phenomenon. It's not a US phenomenon. Everyone's experiencing this. Everyone's experiencing this around the world.
Well, the bad news about the food prices going up is your mom has been to the supermarket and says, prices are going up so high, I'm putting you on a new diet. I'm not allowed to eat anymore.
Well, Dad, hasn't that been the case for the last 40 years?
This is true. This is another new reason. So this inflationary jump in prices is actually impacting my diet, and I'm not happy about it.
I did notice, Bob, you're looking a little more slim on the podcast today.
Well, Rye, flattery will get you everywhere. But, here's a great example of how markets work. If you look at what we call the rotation trade, when growth suddenly stopped leading the market and we had value pick up, right? All of a sudden, financials, energy, these stocks are doing better. You go back 12 months, that's when that transition started to happen. Long before anybody recognized it, long before any of the advisors or strategists or economists recognize it, you look at the trailing 12 months numbers, right? Well, it's energy up almost 100% versus growth up 20. I mean, it's amazing how the market's able to see these things 12 months to a year ahead of time.
Wait a second, Bob. You're saying everybody didn't call this. Go look at our podcast from last fall. We were the only place in the country talking about a rotation, and it was spot on. It was right when the vaccine news came out, right around last October. And since then, in the last 12 months, technology growth has underperformed, like you said, those cyclicals. When we talk about cyclicals every week, our listeners are probably tired of it, but that trend is continuing, and it's remarkable the difference in performance since last October. It's really been now an old school value cyclical type of market. All those innovation trades like the ARK fund are only up 11% over that time frame. It's been a huge transition in the market.
Well, guys, I never thought I'd say this, but I'm actually in the process in some cases of doing tax swaps for some of my clients that bought the ARK fund this time a year ago and offsetting some of their gains. I never thought that I'd have to do a tax swap with a tech stock, but it's a reality we live in.
Well, that's the beauty of the markets. And, what's been happening over the last 10 years is we've had a low inflation environment. And so long duration assets, which is a fancy way of saying growth stocks and long-term bonds, have underperformed as interest rates have gone up because inflation's going up. And meanwhile, you look at the typical portfolio that we review, they have no inflation hedges. They don't have a dime in commodities. They don't have a dime in small cap value. They don't have a dime in anything energy related like our pipelines. And our pipeline index is up 50% this year, guys. 50% plus we get a 6% dividend to boot. This is called the gift that keeps on giving.
It only took us a decade to get there. But that's the point, right? I mean, it's just like everything is cyclical. And we're at a point now where a lot of what's been dormant is starting to awaken, and what's been hot for a long time is starting to get less hot. That's how markets work. The other interesting data that came out was at the jobs report about a week ago as we're recording this. And, the other issue the economy has that we continually point out is wages are going up. We saw a huge jump in wages, hourly earnings for workers. And that's a trend to keep your eye on, because we think, again, that's going to be persistent as the economy continues to heat up here. And if you look at just the revised, all the averages of employees being added over the course of the last couple of months, if this keeps up, guys, by the middle of next year or the end of next year, unemployment is going to be down to 1.6%. Is that the lowest ever, Bob?
That's the lowest ever. That's the lowest ever. We're at 4.8% right now, which just shows you again, it's not the news. And that's one thing you have to watch when you're an investor. It's not the news that you watch. You watch how the market reacts to the news. And the employment number, it was disappointing in terms of the number of people that got new jobs, because there's a lot of people who are so confident they can get a better job that they're actually quitting. but we dropped the unemployment rate to 4.8%, but the market only saw bad news. And that's because the sentiment's kind of bearish right now. So that's a good indication of how the typical investor feels. That's called opportunity, guys. I smell it a mile away.
Hey, I hope you're enjoying episode 56, Payne Points of Wealth. We've literally tripled our subscribers over the last couple of months. It keeps heating up. Thank you so much for the support that enables us to keep doing this podcast. If you really like it, if you appreciate it, please give us a like, give us a 5-star rating on iTunes, leave us a comment or any kind of topics you'd like us to discuss, financially related. And if you're watching this on YouTube right now, give us a like, click on that subscriber notification, that little bell, so you can be updated of all our new content that comes out every single week. Again, we really appreciate the support. If you keep giving it to us, we'll keep doing more podcasts. All right, Chris and Bob, it's the tipping point. This is where we pinpoint the pain point, P-A-Y-N-E, having the biggest impact on your wealth right now. And you know, Bob and Chris, with the literal thousands of financial plans our firm runs on an annual basis, we run more financial plans than probably almost anyone in the country. We found that a lot of you that come in to see us have done such a great job on the savings front. You know, you've done a great job with your budget. You have minimal debt. You've learned to save, and you've actually built up a really nice net worth. But we found that you don't always have all your bases covered. So I thought we could talk about some of the problems you face, even if you're a diligent saver, and even if you have a sizable net worth at this point that's getting you closer to that financial independence.
Well, I'll tell you that number one thing on my list, Rye, is too much in cash. Hey, Chris, how many reviews have we done where someone comes in, not a review with a client, but a prospective client, they come in with 12, 14, 15 statements. Nobody's managing that. It's a mess. It's a collection of investments. But when you add it all up, they're 20, 30% in cash right now.
Yeah, well, the big problem with that, Dad, is that, as we all know, you're not making any money in cash. And you think about when you're saving money, I think a lot of us think about saving money in cash. Well, the problem with that is that it's getting less than zero. So you got to think about your savings in terms of super savings. You want that money to work for you. And the analogy I use, it's kind of a lot like having employees that you pay, but give you no work.
Hey, sounds like Bob, Chris. Sounds like Bob. He's always working on his hair, but he's not working on the podcast and the things he should be doing as much. But we'll talk about that offline. But it's actually, I call it it's like at this point, it's cash amplified, right? Because at this point, inflation has been about 4 or 5%. And if you're sitting in cash, your money's not fluctuating, you're losing 4 to 5% in purchasing power a year based on what inflation is today. So it's worse than ever to sit in cash. And, you know, Bobby, you and I do a radio show every weekend, and we're on with Steve Moore. He's a big economics advisor, was for the Trump administration. He's pretty much out there. And he talked about how he sold out of all stocks because he sees nothing good. And we hear this all the time right now. And he's like, guys, what should I do here? And we're definitely going to get a correction. We said, Steve, you're going to be wrong here, man. You're going to be wrong, brother. Sitting in cash is the worst place to be right now. And he is like one of the best economic advisors in the country, sees more data than anybody, and he's making that mistake. But it's not the right play right now. You can't afford to sit in cash when you have inflationary pressure.
Well, that's the risk you have when you're in a big booming bull market. They never let you in. If you look at every secular bull market that I've been in, and you only see maybe 3 in your lifetime, usually the first one, you're too young to take advantage of it. The third one, you're too old to take the risk. So this is an opportunity to participate in a secular bull market. A lot of people are missing out, but don't mistake that for having the improper asset allocation. Too much risk is still risky. And even though things are going up, nothing goes up in a straight line. So you got to make sure the number 2 risk I see out there is way too much risk in the portfolio, over concentration in certain areas. Can you guess what they are, Chris?
I'm going to say large cap growth, the tech trade.
You got it, man. And guess what's underperformed for the last 12 months? The tech trade, believe it.
Well, the other thing too, Dad, is to think about risk is also subjective. So I have a client that I've been dealing with since I started the business about 10 years ago. And every time we're in a bull market, she wants to take more risk. Every time the market's going down, she wants to take less risk. So, risk feels great when the market's going up, but, as Ryan always says, it's a double-edged sword. It hurts you on the way down too.
Well, that's it. And that's what we see mostly right now is just that lack of diversification. And we this is something that we point out, but Wall Street's the biggest offender of this. And we see this, our industry, you would think our industry would know better. And I actually had a client that I was working with the other day saying, well, I've got this retirement account. It's completely diversified. I don't need you guys because I've got it perfectly positioned. And I went through all the positions. And again, you can have like 20, 30 different funds and think you're diversified, but it was all invested in the same area of the market. And that's what Wall Street does. It tends to look at what did the best the last 5 to 10 years, just like you do. We all do this. It's human nature. And that's what we recommend because it's easy to pick what did best recently. But as we know, things continually change. So whatever's been the best place to be, eventually, like the turn of a switch, just kind of like what happened last October when we had that vaccine news, is everything shifts overnight. And again, you've got to have money in those other places or you're out of luck.
Great. That's a great point. I mean, you look at Wall Street, you look at the banks, you look at the insurance companies, and they really have the two things that they're supposed to do for you as an investor. Number one, act as a fiduciary, and also they have an obligation to their shareholders to make a profit. Guess which way they go almost every time. I mean, Jamie Dimon came out the other day, the CEO of JP Morgan, biggest bank, most profitable bank in the country, and he said, Bitcoin is worthless. He said, it's backed by nothing. However, if you want to invest in it, we'll accommodate that. So again, the profit motive. He takes the profit motive over his moral obligation as a fiduciary to you, the investor.
I love that though, right? It's like, we're happy to give you the shovels to dig. And I mean, that's essentially what Wall Street does, because I've heard a lot of that with Bitcoin. It's like, whoa, all the big banks are getting involved and, Wall Street's getting involved. Yeah, they are, to basically give you the shovels. That's it. They're not the ones actually trading in this stuff. They're the ones profiting on your hard-earned money so you can trade it. They're basically the house. They're the casino that is allowing you to gamble. It's not because they see this as this wonderful opportunity. They see you as the sucker doing the trading, so they make those commissions. That's pretty much the way it works.
Well, like you always say, Chris, it's like 2 out of 3 is not bad, right? The bank made money. The bank advisor made money. The investor got killed. 2 out of 3 is not bad odds. Why? So, the thing is, invest in the bank stock. Don't trust the bank.
And that's why bank earnings are fantastic so far this quarter. So be the owner, not the consumer, right? That's like, that's the old line. So the other thing that we see a lot when it comes to the mistake you're making, even though you may have saved a lot, but this is one of the big areas, is that ticking tax time bomb. If you're just shoveling tons of money into your retirement account, you get to a point where that becomes a very sizable part of your net worth. The problem is when you start taking all that money out, you're going to pay some major taxes.
Right. I was talking to clients of ours this week that have been clients of Payne Capital for 30 plus years, and they recently retired a few years ago, and they don't have any income right now. No Social Security. They're purely living off their portfolio. And one of the things I said to them, I said, why don't we take some money out of your IRAs now and move them over to Roth to save some taxes in the future? And they said, well, we don't want to pay all the taxes right now because everything that comes out of an IRA is a taxable event. And then I showed them how much money they have to take out when they hit 72 and what tax bracket that's going to put them in. And that changed their tune real quick because they'd save a ton of money in taxes right now by converting to a Roth IRA.
Yeah, that's it. And we know taxes are probably going higher. Like, look, I don't have a crystal ball, but I have to think with the trillions upon trillions of dollars that the government's printing right now, they're going to want to get that money back some way, somehow. And it's probably going to be through excess taxation, which means it's a great time right now to look at maybe starting to just rip the Band-Aid off, pay the taxes on some of those retirement accounts now, and later have it completely tax-free. I know Bob loves tax-free. I know, Chris, I know you love tax-free. We all love tax-free.
Well, we always say, guys, render unto Caesar that which is Caesar's, but don't give him any of yours.
Well, this last one's my favorite one, and that one's it's okay to live a little. So, we all have clients that all they do is save, and they stress about making sure that enough money is being put in their portfolios, but they sacrifice the finer things in life, like going on vacation, buying that really cool car, and all the things that just bring us pleasure in life. So, at the end of the day, of course, you always want to be saving. You want to make sure that you're reaching your goals, but not at the sacrifice of enjoying your life because, Dad, as you always say, we don't get out alive.
Yeah. And what are we doing it for, right? The whole idea is you save so you can spend the money. I had a client talk to me about buying a shore house and he wasn't sure about it. And he's like, look, I have to take some money from the portfolio. And I looked around the numbers. I said, take it. He's like, what do you mean take it? Don't you want to just keep managing and charging fees? I said, Chris is like that, but me, I want to make sure that you're living your life. And in all seriousness, that's the point. Like, there's no greater joy than telling your client that, like, look, you've saved this money, you can spend it. That's what it's for, so you can enjoy yourself because you worked hard. Certainly, it's not about leaving all the money to the next generation. Actually, Bob, I take that back. Maybe it is for you.
Brian, I have to comment on the fact that you tell clients that I don't like when they take money out of their portfolio. I tell all of our clients their portfolio is like the Hotel California. They can check it in, but can never leave.
Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. This is all we do. This is what we do every single day. And everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you've saved over $750,000 for retirement, Bob, Chris, and I will put together our famous Total Financial Master Plan. We'll do all the work up front with no obligation or cost. There's no other financial service firm in the industry that does this work up front. We'll take a look at every holding that you have. We'll do a deep dive of every single investment you have. We'll look at tax optimization. We'll look at every fee you're paying, show where you can reduce costs on your portfolio. We'll do a complete savings and income plan to make sure you're on track, saving the right amount of money. And we'll put together a full income plan to make sure that when that paycheck stops, you can live off your portfolio and not run out of money over the rest of your life. It's our Total Financial Master Plan. Simply go to www.paynecm.com/financial plan to see if you qualify for a free complimentary financial review. We literally do about 10 of these a week. If you have over $750,000 saved for retirement, see if you qualify. We'll do all the work up front. Go to www.paynecm.com/financial plan to see if you qualify for a free financial review. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, this month the Energy Department released a study that says as much as 40% of U.S. electricity could be produced by solar in 2035, 45% by 2050, but today solar only provides about 4% of overall energy.
Well, that's a gigantic leap, right? I think renewables are the wave of the future, but they're coming a lot later than everybody thinks. I mean, they're only 4% now from solar energy, and we're going to depend on some bureaucrat in Washington to tell us it's going to go to 50% on a certain date. You know, they've been telling me for the last 40 years that the ocean was going to overwhelm my home on a beach here in Ocean City. I don't think I'm going to take that advice, maybe with a little grain of salt, perhaps.
Bob's not buying it, but I think there is no coincidence that oil is up to $80 a barrel because we probably need fossil fuels for a couple more years than some of the quote-unquote experts have been telling us. Chris, today it costs more than a penny to make a penny. According to the U.S. Mint, it costs them roughly 1.7 cents per every coin.
Well, you know what, Rye? I think the only alternative at this point is to use Bobcoin. It doesn't cost anything to make, and it's completely virtual.
I don't know. From what I've read, that the energy used to make one Bob coin, because, to get all that hair replicated on the coin, literally is all the power of Argentina on an annual basis. But I don't know. Don't quote me on that study. I just heard it somewhere.
Hey, Chris, he's already taken a shot at you. He's taken 2 shots at me today. I think he's forgetting the fact that I now have a grandson and that he doesn't even know he's been written out of the will and replaced by Liam. But, just he'll figure it out sooner or later, I think.
Hurtful, Bob. Hurtful. Bob, Warren Buffett, considered the world's most successful investor, made 99.6% of his $87.5 billion fortune after the age 52. As much as $72 billion of his wealth came after he turned 65. He started investing at the tender age of 11 and paid his first taxes at age of 13. The compounding effect sounds like it's backloaded here, Bob.
Well, it really is. And that's the thing about Warren Buffett. He's a genius because he started investing early, right? Really early, tender age of 11. What it speaks to is the real magic of creating wealth, which is compounding of your interest and dividends. Never leave that money in cash. Make sure you're always buying an asset. There's always an opportunity in the market in your portfolio every day. Don't wait. Don't invest in the market you want. Invest in the market you have. Warren Buffett's done that. He's the wealthiest man on the planet.
Well said. All right, gentlemen, great show. Again, thank you for your support. We've tripled our listenership. If you like our content, love our content, give us a like, give us a 5-star rating on iTunes, give us a great review if you really dig our content. And don't be shy, pass it along, let anyone else know about it. And if it's on YouTube right now, please click that notification bell, that like, so we can keep creating content like this. Give us the support so we can keep giving it back to you. Have a great day. Have a great week. As always, stay loose and keep an open mind.
Well, it's not just here, guys. I actually have a client of mine that owns a retail running shoe store, and he told me that most of the shoes are produced in Vietnam, and a lot of those factories are getting shut down. He's actually having to buy every possible shoe on the market right now just so he has inventory for the next 18 months.
Well, that's the story. I mean, you have semiconductors are all backlogged, steel, lumber, housing's going up like crazy. People are building everywhere. I don't know what they're going to fill it up with. I mean, beach chairs and sleeping bags, because you can't get any furniture. You can't get any you can't get appliances. But you know what? I mean, the market doesn't really seem to care, because here's the thing about the market. The market looks forward. All this is priced in already. Now, we are getting a little bit of corrective action, but that's primarily because what you said, Rye, that the Fed didn't say transitory last week, which means they're starting to believe their own lying eyes, like we've been telling you to believe, that inflation's going up, so interest rates are going up. And I hope all of you listened. Those bond funds are dropping like rocks, and you have to get into fixed income, not bond funds.
Yeah, and again, this is going to be a persistent problem, right? Because the whole idea was these supply chains, there's this big, huge spurt of demand initially, but that's going to start to wane, and all these supply chains are going to get back in line. That's probably not going to happen because you don't have enough workers. That's one of the things we've talked about week after week on this show is we've got a labor shortage. We don't have enough people that could actually even man the supply chains to make sure that goods and services get essentially done on time. And this is going to just persist for a long time. And the one thing you're seeing is it was like 44% of conference calls or earnings calls this last quarter. Every company was talking about one thing, inflation, inflationary pressure. And as we know, guys, we know who's going to end up paying that higher cost at the end of the day.
Well, it's not just inflation of products. It's also wage inflation. One of the things that happened during this pandemic, a lot of people my age retired. Hey, that's a great idea. You know what? I think I'm going to retire. What do you think, guys?
No.
I mean, I'm coming with you, Bob.
Well, you know what, guys? Speaking of having trouble getting employees, I was talking to a client of mine who's a dentist up in North Jersey, and his primary assistant retired earlier in May, and they haven't even been able to get somebody. And then he told me about a friend of his who's a dentist, and he's answering his own phones. So you think about this, like, how busy it is when you go into the dentist office. Could you imagine the guy that's working on your teeth is not only working on your teeth, but also answering the phones?
It's literally every business right now. I talked to an estate planner we work with, and she said, well, I'm just not going to take new work in the next couple of months because we have too much to work on now. So it's literally like they're cutting off bringing new business. Like, imagine that.
Well, things will evolve. Things have become more automated. The jobs will change. So some of these skills that workers who do want to come back to work may not apply right now. So there's going to have to be a little bit of re-education. But, all this will work out because the market, again, incorporates that all into the current pricing, right? We're getting a little price adjustment right now because rates have gone a little bit higher. So you're getting a price adjustment in stocks. You're getting a bigger price adjustment in bonds. And you just got to be careful that you have a well-diversified portfolio, one that doesn't include bond funds.
If you didn't get the message, Bob does not like bond funds. Well, it's a good point because earlier this year, when we did see the Treasury yield spike up to 1.7%, and as we're recording this, we're around like 1.5% today, is tech stocks got whacked, right? And because it's kind of the anti-inflationary trade. When you start looking at tech stocks, they trade on profits way out into the future. Well, when you have inflation, no one cares about way out in the future. You care about immediate profits now. And that's where, the name cyclical stocks comes from, is those stocks go with the cycle of the economy. And right now, the cycle of the economy is the economy's heating up. So those cyclical stocks are going to heat up as well. It's kind of a simple concept, but it's an important one. And that's why you need to position your portfolio with those quote unquote cyclical stocks.
So Chris, here's the Dean of Common Sense again, giving investment advice. The price of oil is going up, so buy oil stocks. Interest rates are going up, so buy banks. Wow. You're always right about these things. It's such common sense. It's like it's in plain sight. What have been the best performers over the last couple of weeks? Oil stocks, bank stocks, industrial stocks, what we call cyclical stocks. So you just have to make sure you're in those stocks before they go up. You know what I always say? You make more money, create more wealth owning the most amount of shares of something before it goes up. That's why we buy low here. It's, the dean of common sense, Mr. Ryan Payne.
Guys, what's it like being around my brilliance all the time? It must get annoying. I'm sorry.
Gives me a headache, Chris. I don't know about you.
I'm not sure what's more annoying, your ability to be right all the time or your massive ego.
And how about commodities this year? My goodness, we look at 40, 50 portfolios a month. There's a couple of things that these portfolios never have. They never have commodities. They never have small cap value stocks, right? They never have international stocks. It's amazing how many investors out there don't have a portfolio with the key elements of success.
Yeah, and again, we talk about this a lot, but the dynamics are shifting here, right? I mean, we talked about inflation for a long time. We said, don't listen to the Fed; it's not transitory. And now the Fed's saying, you know what? Guess what? We were wrong. It's not transitory. And I think that's indicative of what's going to be here. This phenomenon of inflation, which we didn't have the last decades here for a while. So it's a different type of portfolio that works in that environment. So it's, again, kind of a simple concept, but it's an important one. But I think the other thing to think about here too is everybody's waiting for that dip this fall, right? Everyone's waiting for that other shoe to drop. There's a lot of issues with this Delta variant rising. There's a lot of issues, again, with supply chains, and economic growth is going to slow down a little bit, but still it is improving. But as we're seeing here, because there's so much money out there, is you're not getting any dips. So I think the other mistake you're going to make here is sitting in cash is not the place to be. You've got to get invested, and you can't wait for this big dip because so far it's not happening. We did tell you that too.
Well, we are getting a little dip this week, right? I'll tell you, Chris, I'm excited because all of our portfolio holdings went ex-dividend. We're going to have a bunch of cash to put to work on Thursday, and I just hope this market stays down long enough to give me really good prices for my clients.
Well, guys, I can't imagine why anybody would want to sit in cash. I mean, you're getting less than 1% in your money market, but if you think about it, not only do markets go up over time, but everything we own in our portfolio pays a dividend. Right. So it's getting basically, I always say the market bribes you to wait just because those dividends come in every single quarter, no matter what. Even back in 2008, back in March during the height of the pandemic, we were still getting that cash flow. So you can sit on the sidelines and wait, but chances are the market's going to pass you by.
Well, Chris, I've been keeping money in cash for my bar stools. I guess that was a bad idea.
Dad, I've got some sound advice for you. Why don't you give it to your grandchild?
I seriously doubt, Bob, that you had any money just sitting in cash. But no, I think that's the bottom line here, right? When you think about the economy right now, you think about investing, it's really just simple. There's trillions of dollars the government's created. It's all out there. Either that money is going to get spent in the economy, and we know Bob's going to help that out in a big way, or you need to get a return on your money. You can't just sit in cash when you have inflation because it earns nothing. So that money's going to funnel its way into the stock market because you are getting a return there. So, to keep this simple here, guys, look, inflation's real. It's kicking in. The Fed has been telling you a lie. So you've got to be smart here. You've got to diversify. And when I mean diversify, you've got to have those inflation hedges in your portfolio because inflation's real. You don't want to sit in cash. That's like the anti-inflationary trade, and you don't want to have all your money in tech. You heard it here first. Get that money to work. Get it diversified. Be prepared. Hey, hope you're enjoying episode 54, Payne Points of Wealth. We thank you for the support. We literally have doubled our listenership. It keeps growing month after month. So please don't keep us a secret. Click that like button. Give us a 5-star rating on iTunes. Leave some comments. And if you're watching this on YouTube right now, click that subscribe button. You can click that notification key. So every single week you'll be notified of our new episodes. Thanks again for the support. Love our content. Keep supporting us so we can keep creating all this content just for you. Okay, Chris and Bob, it's the tipping point. This is where we pinpoint the pain point, having the biggest impact on your wealth right now. And Chris and Bob, we manage to look at like 50 portfolios a month at our firm, Payne Capital Management. We probably see more strategies than any other firm on Wall Street. We know exactly what different advisors are offering, what their services are. But we find a lot of times when you come into our offices is you might have a really nice advisor or broker at whatever firm you're working with, but they're not exactly doing a very stellar job. So I think we talk about some of the ridiculousness of some of the statements we might say or to justify or rationalize the fact that we do have a nice advisor, but they're not really giving us really good advice.
I can't tell you how many times I've seen that. It's, just because they worked with somebody it's easier not to move to someone else who may be better because most of you have had bad experiences. It's almost like you're afraid to go from the pot to the fire because last time I switched, that person made all kinds of promises and they were worse than the person I left. So I can understand, the reticence to move your portfolio or your planning to someone else. Proof's in the pudding. I think you've got to see the action, not the words.
Yeah, and one of the comments I hear often is we never get together for reviews. I rarely get my phone calls returned, but I know he is really busy and he worked with my dad for years, so I assume he's taking care of me. He's probably not,
Well, you know what they say about assumptions. You should never assume that they're working for you.
Well, I got a good question from a prospective client who called and asked me about our services, and they said, well, someone told me it's really important that your advisor is local. And I said, not necessarily. I know lots of different people that have had advisors locally and they never heard from their advisor, whereas now we have clients all across the country. We do Zoom calls. We check in on a monthly, quarterly basis. So I would be more concerned about the service model. And if you're not getting proactive service, whether it's a phone call, Zoom call, or even if they're around the corner, it doesn't really matter. It's all about that proactive service because it is a service, right? And if you're not getting service, you're paying for a lot of actions that you're not getting.
Well, my favorite is when you sit down with someone and they do have a primary advisor, but that primary advisor doesn't do a full review, doesn't have a 360 financial portal like we do. So they don't have a full picture. They basically take this segment of your portfolio that you've allowed them to manage and they manage it in a vacuum. They don't know that you have an additional $5 million custodied at 10 different places. And so when we sit down and we put it all together, most of these newer clients are shocked to find out that they're 25% in cash, that they have 50% of their portfolio in the same asset class, that they own bond funds. I mean, it's amazing that I don't know if the client's reticent to let somebody know where everything is, or there's just a lot of lazy advisors out there who don't want to do the work.
It's really irresponsible. It's like going to the doctor and the doctor just gives you a prescription without doing a full exam and finding out what the root causes are.
Well, there's an important concept, right? You want your money all working in concert. But the problem is most advisors or quote unquote brokers, they're mostly brokers, are in the business of selling you products, right? Putting your money into something we hope is good. I always hear that. I hope it's pretty good, the investment he or she put me in. Which is a horrible way to invest, right? Because it's more about like, I'm buying this and essentially it's part of an overall strategic strategy. And you're right. That's the problem when you have like 10 different advisors. You get like 10 cooks in the kitchen and you never get that concerted effort. And that's like the hallmark of really good financial planning is to have a concerted effort with all your money.
Well, it's like a lot of time we get these questions like, I don't, from prospective clients, I don't really understand what's in my portfolio. And when I ask my advisor about it, he or she explains it to me. I just don't really get it.
Well, you need to know what you own. You need to know why you own it, because there's a lot of advisors that I have worked against, I guess is the way to look at it, right? Because I've taken their accounts away from them, where these people are prejudiced. They're prejudiced against equities. They're prejudiced against fixed income. One of my nearest, dearest clients who's become a great friend lost $1 million back in the 2000 market decline because his stockbroker didn't like bonds. This guy's 70 years old. He didn't have $1 in bonds. I said, why don't you have your money in safe bonds? My broker doesn't like them. I mean, what does what you like have to do with helping people achieve their goals?
Yeah, and it's terrible. And again, it's like, we try to use all this fancy language. Bob told me he uses the fanciest language he can to keep people in the dark so he can keep his job. That's how he's gone for over 45 years.
No, right. That was when I wanted to be a lawyer.
But of our industry is just so guilty of this, right? We love that. I mean, it's just like nothing is worse than sitting across from a client and just seeing their eyes glaze over because you're talking over their head with all the financial jargon. It's like the worst thing you can do. And I think the hallmark of a good advisor, I'm using that word hallmark a lot today, is when someone can break things down into a simple way for you to understand it. Because everything we're doing here is not rocket science, right? I mean, if it feels like rocket science, you got a problem. It should be common sense. And I think we just, our industry is terrible at this. They make it seem like everything's behind the curtain here. Leave it to us. We'll do everything. Don't think. And that's not where you want to be with the relationship with your advisor. You need to understand. You need someone who can articulate what they do to you in a simple manner.
Chris, it sounds like to me, Ryan saying if you have something like crypto in your portfolio, private equity, hedge fund, long, short, absolute value fund. Somebody's talking about the, capture of the portfolio, the low vol, high vol. You might have the wrong person.
Well, there you go, Dad, using all those complex terms. But going back to Ryan's point, not only should you be able to understand what's in your portfolio, you should also understand how it relates to you and the goals that you're trying to achieve.
Yeah, if you don't know what you own and you don't know why you own it, you won't stay invested. I mean, I spent my first 10 years, rebuilding my clientele because they thought, hey, Bob, you're investing money for to make money. As soon as it went down, they'd say goodbye. I couldn't attach their emotional resolve to a portfolio. It has to be attached to your goals, to a purpose, to a meaning.
Yeah, exactly. Your goals and understanding it. And I think this is why crypto to me is a big red flag. It's just because when people explain it to me, I literally think they're talking about something that's out of sci-fi. There's words like DeFi. And, you have this, it's tethered. And you're like, what the heck are they talking about? And it's scary because you hear people that are way into cryptocurrencies and they're into SPACs and they don't really understand how it actually works. And you kind of realize they don't understand it and they just make it sound so complicated. So it sounds like they know what they're talking about, but they probably really don't.
One of our favorite clients texted me this week and he congratulated me on the birth of my grandson. And the market happened to be down 600-700 points that day. He said, can you believe it? Bob's grandson's born and the market drops like a rock. And I reminded our good friend, the Colonel, that, hey, this allows me to buy low in my grandson's 529 plan because we're investing based on a goal. Then there's no emotion, makes it simple. The best time to buy is when the opportunity presents itself.
The last complaint I hear is, I know the market's been up big the last couple of years, but my portfolio doesn't seem to have done that well. But my advisor's a really nice person, and I haven't wanted to make a change.
Hey, Chris, we're working with that trust account right now. The advisor was a financial magician. He took a great 10-year market. I mean, one of the best 10-year bull markets I've ever been in, and he managed to lose money for this trust. If that's not a magician, I don't know what is.
That's totally a red flag. And what we find a lot of times is when we go and review these portfolios where, okay, the market did great, but maybe you didn't do anything, it's because typically the fees are exorbitant. Like a lot of these annuities, I hate to pick on annuities, but sometimes the fees are 4 or 5%. If you're taking 4 or 5% to the insurance company every year, how in the world are you ever going to get a good return on your money? So that's a total red flag. I don't care how nice that insurance person is, broker, advisor, but you've got to get a second opinion and just start to deep dive into that portfolio because just because they're nice doesn't mean they're not robbing you.
That's such a great point. I had a client call the other day and he said, Bob, what's my portfolio up, right? And with our software, we can tell you where you are year to date since inception, last month, last week, right? It takes 30 seconds, 10 seconds? We called his insurance guy and he's had an investment in this insurance plan for 20 years. Doesn't know the return. We're still waiting 6 months. He can't tell us what the rate of return is. Maybe he doesn't want to tell us.
Dad, relax. It's complicated.
That's right. Nothing to see here. Look the other way. And that's the crazy part too is we're trying to get some information on this one annuity and the insurance company says, oh, no, we can't give that information out on hypothetically how this annuity would have done or, what the payout would be. It can only be done once a year and you have to request it ahead of time. And they make it so convoluted, so hard to get information that you just give up. You're like, I give up. I don't even know. I'll just keep this product. And I mean, there's a lot of that designed to keep you in the dark where you just don't want to look at your investments and figure out what's going on.
Guys, I'll sum up the tipping point this week. When you were growing up, I said, never go to a deli where you buy mystery meat. Don't go with an advisor where you get mystery investments.
Hey, hope you're enjoying episode 54, Payne Points of Wealth. Bob, Chris, and I now have a collective 75 years helping individuals just like you if they're planning and investing. I mean, we literally been do this every single day. This is all we think about. And everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially at any stage of your journey. But if you have over $750,000 saved for retirement and you want a more hands-on approach and you want to get a full review of your portfolio, you can apply for a complimentary financial review by Bob, Chris, myself. Go to www.paynecm.com/financial plan to see if you qualify for a full holistic financial review. We do a deep dive of everything. We'll go through every investment you own. We'll look at your diversification. We'll look at what fees you're paying. We'll show you where those hidden costs are. We can reduce those fees on your portfolio. We'll take you through a full savings and income plan to make sure that you're on track with what you should be saving for your financial independence. We'll look at essentially, we're gonna look at putting together a full income plan for you so you know exactly what you can draw from your portfolio later. We're gonna look at tax optimization so you're not paying more in taxes than you should be. There's no other firm in the country that does this type of review and does this work up front. So see if you qualify for a free financial review. Simply go to www.paynecm.com/financial plan. That's www.paynecm.com/financial plan. Hey, hope you're enjoying this episode 54, Payne Points of Wealth. Show us some love. Give us a like. Subscribe to our channel. We've doubled our listenership. We really appreciate the support so we can keep doing this. If you're on iTunes, give us that 5-star rating. Leave a comment. And if you're watching this on YouTube, you can subscribe. Click that little notification bell so every week you can be updated of all our new episodes literally coming out weekly. All right, gentlemen, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. So, Bob, on September 30th, 1981, amid high inflation and a crippling recession, the 10-year Treasury note yielded 15.82%. Far cry from the 1.5% we have today.
I mean, think about it, guys. You had a return, a yield on a government guaranteed investment that was 50% above the historical return in the stock market with virtually no risk at all. Now, here's the lesson that's learned from that. Always invest in the market you have, not the market you want. I had a prospective client back at 81. He owned a big roofing company, and for his pension fund, I said, let's put a ton of money into the 10-year Treasury. He said, no, Bob, it's only 15.82. I want 16. And he sat in cash for the whole period. He sat in cash, and while rates went all the way from 15.82 down to 1, never invested.
Unbelievable, man. I would love to get a guaranteed 15% a year. That's pretty sweet. All right, Chris, IRA plus 401k balances built by U.S. savers by generation. Baby boomers have logged in an average of $462,000 in retirement accounts. Millennials have an average of $66,000. And Generation X has an average of 247. We're catching up on those baby boomers.
Well, guys, it's no secret that the baby boomers are the wealthiest generation. But what really concerns me here is how dismal the millennials' savings amounts are. You know, it just goes to show you, as a millennial myself, you really need to start getting serious about your financial planning and start to build up those 401ks, IRAs, and brokerage accounts.
That's good you said that, Chris, because Bob and I have been waiting for you to get serious for a very long time.
I just need a good financial advisor.
He's not just going to sell you products, high-fee annuities. Bob, easy money has helped to swell the balance sheet of U.S. households whose net worth has soared to a record $141 trillion as of June 30th. We're getting rich.
I'll tell you what, I love it, Rye. I love the fact that we're the wealthiest as a country as we've ever been in history. Pretty soon I'll be heading down to Florida, playing with some of the retirees and visiting with some of our clients down there. And I can't wait for them to tell me, well, that's really good, Bob, but how's that possible when things are so bad? It always drives me crazy. People don't understand. Things are good. It's the best they've ever been. And it's not just the stock market. Real estate prices are going through the roof. And Chris, millennials, well, they're going to be in good shape because starting this year, $2 trillion a year is going to transition through the estates of the wealthy baby boomers who are passing down to the next generation. $70 trillion is moving downstream over the next 10 years. Guess what, guys? That's going to find its way into financial assets.
Well, Bob, Chris and I would like to talk about your wealth transference plan after this episode.
I have a grandson. You guys are out.
I knew it.
Foregone conclusion.
So, Chris, there's 13 U.S. corporate tax hikes on record going back to 1925. In the ensuing 12 months, the S&P rose 9 times, averaging 11.1%. On the personal income side, Congress has hiked the top bracket 14 times. The S&P rose in the next 12 months after 10 of them averaging a whopping 16.8%. Sounds like raising taxes is actually good for the market. Who would have thought?
Well, boys, I'll tell you what, one of the biggest fears that my clients have right now is that a tax hike is going to have a negative impact on the market. But it sounds like based on these statistics, that's probably not going to be the reality.
I think the bottom line is a bull market is going to be a bull market regardless of short-term moves in taxes. And as we've said here first, we know money's got to go somewhere. Better be bullish than foolish, as Bob likes to say. All right, another great episode. Thank you again for your support. If you like our content, love our content, please click on that like button, subscribe, forward this to a friend, anyone can benefit from our ever ongoing quest to give you the best financial information. Have a great week. As always, stay loose and keep an open mind.